Technical analysis made easy, a starting place for new traders. When you hear the news that the Dow Jones was up 100 points or that crude oil futures were down $2, it's easy to think of those price moves in a linear fashion. A straight line from the open price to the closing price. What you don't often hear is how extreme those markets were up or down during the day to get to those final prices. That variance, or volatility in the price over time, is crucial for a trader to understand because it represents the potential risk or profitability of a market. Although technical analysis is primarily concerned with when to enter and when to exit a trade, a study of volatility can also help you choose what to trade by comparing symbols for a risk-reward profile that matches your trading style. Volatility is another one of those core concepts that traders need to master. One way to describe market volatility is that it is essentially a measurement of risk and opportunity. Volatility is generally calculated based on prices moving up and down in either direction relative to the normal price action over a period of time. There are different ways traders can measure and quantify volatility: the bar range, standard deviation, and implied volatility based on options prices. In this video, we will focus on volatility based on price movement. True range. One way to measure volatility is to start with the range of a bar. Range is the price movement from high to low on a single bar, or as a formula, high minus low. In order to take price gaps into account, traders use a more robust calculation called true range, which also takes into consideration the close of the previous bar. By averaging true range over some number of bars, we can visually chart the volatility of any asset historically. This indicator is called average true range, or ATR. When the ATR indicator is trending upward, volatility is increasing, and when it is trending down, volatility is decreasing. If you think of ATR as the potential for price movement, you can apply these values to set profit target or stop loss order levels. For example, you can place exit orders using entry price plus or minus 2 ATRs. Keltner Channels. Traders have applied this ATR concept in lots of creative ways. A popular ATR-based indicator is Keltner Channels, which uses ATR to project support and resistance levels from a moving average. The default parameters for Keltner can vary. A good starting point is a 20-bar average with 1.5 ATRs up and down, but you can always modify the number of ATRs and look-back bars for the average calculations. There is no perfect set of inputs. Keltner Channels can provide a number of useful indications. As a support and resistance tool, prices tend to pause or reverse at the Keltner levels. But if prices break out from these levels, it can also signal a new trend. Keltner Channels provides a visual framing of historical market volatility. Look for consistent patterns and levels in Keltner that may better help you react to the current price action. Bollinger Bands. The Bollinger Bands indicator is another popular volatility-based indicator that uses the standard deviation calculation. Bollinger Bands uses standard deviation to project support and resistance level from a centerline moving average. Both Bollinger Bands and Keltner Channels look very similar on a chart. The default parameters for Bollinger Bands is a 20-bar moving average, with support and resistance lines 2 standard deviations from the average. Bollinger Bands can help traders determine if market prices are stretched too high or too low relative to average prices, and is generally used by traders to help identify a reverse in the current trend. When prices first hit and cross above the upper Bollinger resistance band, traders will watch for prices to reverse and cross back under the upper band for confirmation of the reversal. And the same idea is true for the lower support band as well. Bollinger Bands, like Keltner Bands, can be used in all financial markets and can be applied in most time frames, from minute bars to daily, weekly, or monthly intervals. Standard deviation. In statistics, standard deviation is a measure of variation in a set of values. A low standard deviation means that the values tend to be close to the mean, while a high standard deviation indicates that the values are spread out over a wider range. Think of a bell curve, with the mean at the top and each value falling somewhere on that curve. So, when applied to market prices, there is a 68% probability that any one price will fall within -1 and +1 standard deviations from the mean, and that 95% of all prices should fall within -2 to +2 standard deviations. Another way to look at two standard deviations would be to say, only 5 out of 100 prices would fall this far away from the mean, so a pretty rare event, and a possible strong support or resistance level. Implied volatility. Another type of volatility, implied volatility, is the volatility value implied by the prices of options for that instrument. The most widely followed implied volatility indicator is the VIX, or Volatility Index, which is derived from the options prices of the S&P 500 index options. And there are other VIX-like options-based volatility indexes for a wide range of symbols. When VIX is rising, prices tend to decline as there is a greater sense of risk in a falling market, and prices tend to rise when VIX is falling. Plotting VIX and the S&P features in the same chart will show off this opposite correlation very clearly. In conclusion, volatility is a key component of technical analysis and can give you helpful insight into the price movement potential for the markets you're trading. In our next video, we'll discuss chart patterns and how they can help you identify turning points in the market. Thank you for watching.